Okay, get this. Ever imagine refinancing your home loan in less time than it takes to plan a vacation?
Seriously.
I'm serious. Today's deep dive is all about how VA loans can make that a reality.
No way. What are we talking about here?
Specifically, this thing called an IRRL.
An IRRL.
Yeah, I know, another acronym, right?
Huh?
It stands for Interest Rate Reduction Refinance Loan.
Okay.
And we're going to unpack why that's way more exciting than it sounds.
Right, you're right. It's not the catchiest name, but for those eligible, it can be a game changer.
Right.
We're diving into this article from National VA Loans so you can walk away knowing if an IRRRL is your shortcut to some serious savings.
Because who doesn't love a shortcut, especially when it comes to paperwork and shaving, dollars off their monthly mortgage payment?
Ah,
So break it down for us. What makes this IRRL different from, just any old refinance?
Imagine this. You could be kicking back, enjoying your newly refinanced lower interest rate in as little as 10 days.
10 days.
Some IRRLs close in just 2 weeks compared to the usual 1 to 2 months with traditional refinancing.
Whoa, that's less time than it takes me to decide what to order at a new restaurant. But what's the catch? Why isn't everyone talking about this?
Well, it's specifically designed for veterans who already have a VA loan.
Right.
Think of it as a perk for those who've served.
Okay. That makes sense. But why so much faster? Is it just less paperwork, or is there some kind of financial sorcery going on?
Think of it as the express lane for refinancing. The VA has streamlined the entire process. No need for income verification, asset assessments, or employment checks. And here's the kicker. No new appraisal.
What?
This saves you time and money, which, let's face it, are always valuable.
Okay, that's huge. I can see why they call it a streamline refinance. It's like they've removed all the speed bumps on the road to a lower interest rate.
And on top of that, the VA sweetens the deal with some pretty incredible perks that you won't find with a typical refinance.
Really?
For example, did you know you can often roll your closing costs right into the new loan?
Wait, really?
Yeah,
Most loans make you pay those up front, right?
absolutely.
That's a game changer for people who want to refinance but maybe don't have a ton of cash on hand.
Exactly. It's practically unheard of with other loans. Even the FHA Streamline program, which is also a government-backed option, doesn't allow this.
Wow.
This roll-in feature even includes discount points, which are upfront fees that can lower your interest rate even further. Talk about a win-win.
Hold on, let's rewind for a second. You mentioned discount points. What exactly are those and how do they work?
Great question. Essentially, discount points allow you to pay a fee up front to buy down your interest rate.
Lie down.
Yeah, it's like prepaying a bit of interest in exchange for lower monthly payments down the line.
Okay. I'm starting to see the appeal. You're basically making a strategic investment up front to save more money over the life of your loan.
Precisely. And the great thing about rolling those discount points into your IRRL is that you don't have to shell out thousands of dollars up front. It's all about making refinancing as accessible and beneficial as possible.
Okay, so the VA is all about convenience and making life easier for veterans, but we all know there are always rules, right? What are some of the guidelines for an IRRL?
You're right, the VA isn't just handing out free money here. They want to make sure that refinancing through this program actually benefits the borrower in the long run. One of the main stipulations is that the IRRL must actually reduce your monthly mortgage payment. No lateral moves or, heaven forbid, increasing your payments.
Right, that makes sense. It's all about putting more money back in your pocket, right?
Exactly. Another important guideline is that any fees you decide to roll into the loan, like those discount points we discussed, have to be recouped within 36 months. This ensures that you're not just delaying the inevitable and ending up with a bigger financial burden down the line.
So no taking out an IRRL just to snag a slightly lower rate for a few months, then turning around and refinancing again. The VA is one step ahead.
Absolutely. These guidelines are in place to protect you, the borrower, and prevent any shady lending practices. It's about making sure this program is used responsibly and to its full potential.
I love that. Okay, so we've got the streamlined process, the flexible closing costs, and the VA's commitment to protecting borrowers. What else is there to know about how this whole IRRL thing works?
Well, let's talk about occupancy requirements.
Okay.
With a traditional refinance, you usually have to prove you're currently living in the house.
Right.
But with an IRRL, you just need to certify that you previously lived there.
Okay, now that's interesting. It sounds like the VA really gets the unique situations military families can find themselves in, but how does that play out in real life?
Think about it. Active duty military families often face those whirlwind PCS moves.
Right.
They might buy a home, but then get orders to relocate before they've even had a chance to unpack.
Oh, wow.
The IRRL gives them the flexibility to refinance quickly, maybe even rent out the property, and avoid taking a financial hit.
It's like the VA understands that life throws curveballs, especially for those who serve. That's huge.
It is. And speaking of things that can save you money in the long run, let's talk about another perk of the IRRL program, the Energy Efficient Mortgage, or EEM.
Oh, right. The EEM. I almost forgot about that. It's like a bonus round for homeowners interested in making their homes more eco-friendly.
Exactly. With an EM, you can borrow up to $6,000 on top of your refinance to make energy-saving improvements to your home.
6 grand? That's not chump change. What kind of upgrades are we talking about here? Give me some examples.
Think new windows to keep those energy bills down, upgraded insulation to seal in the warmth, maybe even solar panels if you're feeling ambitious and want to shrink your carbon footprint.
Okay, I see how that could be a huge win for homeowners. It's like getting a head start on those improvements while also locking in a lower interest rate on your mortgage. Two birds, one stone. But is the VA just handing out this extra money, like left and right?
Not quite. The EEM isn't about funding a lavish kitchen remodel or adding a swimming pool.
Right.
It's specifically designed to make your home more energy efficient. You have to itemize the planned improvements, and the loan amount is capped at what's actually needed for those specific projects.
So no using that extra cash for a fancy new hot tub, I guess. Bummer. But it makes sense. It's about, responsible home improvement and long-term savings, not just splurging on upgrades.
Exactly. And let's be real, lower energy bills are a win for both your wallet and the environment.
Absolutely. Okay, we've covered a lot of ground here. Streamlined process, flexible options, even a little bonus round for energy efficiency. But before we get too far ahead of ourselves, let's address the elephant in the room. What are the actual eligibility requirements for an IRRL?
Right. It's not a free-for-all. To qualify for an IRRL, you need to meet a few key criteria.
Okay.
Firstly, you need to be a military veteran with an existing VA home loan. This program is specifically designed for those who have already used their VA loan benefit.
So no using NRL to refinance a conventional mortgage, no matter how good your credit score is.
That's right. It's all about maximizing the benefits for those who have served. Secondly, you need to genuinely want to refinance for a lower interest rate.
Right.
The program is called Interest Rate Reduction Refinance Loan for a reason, after all.
Well, duh. Who wouldn't want to lower their interest rate if they could? But I get it. There are always those fine print details. What else is there?
Lastly, you need to have lived in the home as your primary residence for at least 6 months before applying. This helps ensure that you're not just trying to flip the property quickly for a profit.
It's like a sanity check, making sure it's really your home, not just an investment property. That makes sense.
It does. The VA wants to see that you're invested in the home as a place to live.
Okay, so we've got the who covered. Now let's talk about the what. Can you use an IRRL for anything you want with your mortgage? Like, say, finally getting around to that kitchen renovation you've been dreaming of.
That's a great question, and it brings us to a key limitation of the IRRL. Unlike some other refinance options, this program is strictly for interest rate reduction. You cannot pull out any cash from your home equity.
So even if your kitchen is begging for an upgrade, you can't tap into your home equity with an IRRL.
That's correct. If you're looking to access cash for renovations or other expenses, a different type of refinance, like a VA cash-out refinance, would be a better fit.
Good to know. But sticking with the IRRL, are there any other fees or costs involved that people should be aware of? I'm all about transparency.
While the IRRL is designed to be cost-effective, there are a few expenses to keep in mind. Firstly, you'll likely encounter a VA funding fee, which is a percentage of the loan amount.
Okay.
This fee helps support the VA loan program, making it possible for veterans to access these incredible benefits.
Okay, that makes sense. Supporting the system that supports you. How is that funding fee calculated, though? Is it a flat rate, or does it vary?
It's calculated as a percentage of the loan amount,
Mhm.
and it can vary based on several factors, like whether you're a first-time or subsequent VA loan user, the amount of your down payment, and your loan amount.
So it's not like one size fits all. There are nuances based on your individual situation.
Exactly. But the good news is you can often roll this funding fee into your loan balance, just like the closing costs, to minimize your upfront expenses.
Right, we talked about that earlier. The roll-in option seems to be a recurring theme here, which is great for accessibility. What other costs should people be prepared for?
You'll also encounter the typical closing costs associated with any mortgage, things like appraisal fees.
Hmm.
Although remember, you likely won't need a new appraisal with an IRRL,
Right,
credit report fees, and title insurance.
right.
But again, the good news is that these can also usually be rolled into the loan.
It's like they thought of everything to make this process as smooth and budget-friendly as possible. So how long does this whole shebang usually take? We know it's faster than a traditional refinance, but give us some concrete numbers.
You're looking at a processing time that typically ranges from a few weeks to a few months, as opposed to the month-long process of a conventional refinance.
Okay, so still faster. Even with those longer timelines, I can see the appeal there. But let's address another common concern: credit scores. Is it even possible to get an IRRL with less than perfect credit?
It's definitely a question many veterans have, especially those who may have faced financial challenges. And the good news is that it is possible to secure an IRRL with less than perfect credit. However,
Always a however, right?
it's more about managing expectations than a hard no. Securing an IRRL with bad credit might be more challenging. You might not qualify for the most favorable terms, like the lowest interest rates or the ability to roll in all your closing costs. It all comes down to finding the right lender and exploring your options carefully.
So it's not a deal breaker, but it's something to be mindful of. Don't be afraid to, shop around and find a lender who understands your situation and is willing to work with you.
Exactly, and remember, a less than perfect credit history doesn't have to define your financial future. There are resources available to help you understand and improve your credit, and a knowledgeable lender can guide you through that process.
I love that. It's all about empowerment and finding the right resources. Okay, before we move on, let's circle back to the article we're dissecting today. I'm sure our listeners are eager to hear some of those, like, burning questions addressed.
You're right. Those frequently asked questions are often gold mines of information.
So first up, is there a magic number when it comes to how much your interest rate needs to drop for an IRRRL to make financial sense?
Unfortunately, there's no one-size-fits-all answer. It's tempting to think any reduction is a good reduction, but in reality, you have to weigh the potential savings against the closing costs involved.
Right.
Even if those costs are rolled into the loan, they still add to your overall debt.
So it's not just about chasing the biggest interest rate drop. It's about finding that sweet spot where the savings outweigh the costs. That makes sense.
Precisely. A good rule of thumb is to aim for at least a 1% interest rate reduction to make the IRRL worthwhile. Of course, this can vary depending on your loan amount, the remaining term of your mortgage, and those all-important closing costs.
It's like anything else in life. There's no one-size-fits-all answer. It's about doing your homework and figuring out what makes sense for your unique situation. Okay, next question. Can you actually change your loan terms with an IRRRL? Like, say, going from a 30-year mortgage to a 15-year?
You absolutely can, and that's where things can get strategically interesting.
I knew you'd like that word. Strategic. I'm all ears. Why would someone want to adjust the term of their loan during an IRRL?
Let's break it down. By shortening your loan term, you're essentially condensing your repayment schedule. You'll be making larger monthly payments, but
But you'll pay off your mortgage faster and potentially save a significant chunk of change on interest over the life of the loan, right?
you got it. While it might seem counterintuitive to increase your monthly payments while refinancing, it can actually be a savvy financial move in the long run, especially when interest rates are favorable.
I can see how that would be appealing to some people, especially those who are maybe a little further along in their careers, have more financial stability, and want to be aggressive about paying down their mortgage.
Exactly. It's like choosing the express lane on your mortgage. You might be moving a bit faster, but you'll reach your destination, financial freedom from your mortgage, sooner.
I love that analogy. But let's be real, it's not always feasible for everyone to increase their monthly payments, even if it means paying less interest overall. Some folks need to keep those payments as manageable as possible.
You're absolutely right, and that's where the other side of the coin comes in. What if I told you that sometimes extending your loan term during an IRRL can also be a smart move?
Hold on, back up. I thought the whole point of refinancing was to get rid of that debt faster, not prolong it. Why on earth would someone want to extend their mortgage?
It's all about aligning your financial tools with your current goals. Let's say your top priority is to lower your monthly payments as much as possible, maybe to free up some cash flow for other financial goals.
Okay, I'm following. Maybe those goals are things like home renovations, finally tackling that credit card debt, or even investing in retirement. Everyone's got their priorities.
Exactly. In those situations, even if you can't snag a drastically lower interest rate, Extending your loan term during an IRRL could still lead to a noticeable decrease in your monthly payments just by spreading them out over a longer period.
So it's like choosing the scenic route on your mortgage. It might take a little longer, but the monthly burden is lighter, which can be a lifesaver for some budgets.
Exactly, but you're right, there's a trade-off. While extending your term might lower those monthly payments, you'll probably pay more interest overall simply because you're paying interest for a longer period.
Okay, so it's all about finding that balance between short-term relief and long-term costs. Not always an easy decision.
You hit the nail on the head. It's a balancing act, just like so many things in finance. You have to weigh the benefits of those lower monthly payments against the potential for higher overall interest costs. There's no right or wrong answer. It all depends on your personal circumstances, your financial goals, and your risk tolerance.
This is why I'm always harping on the importance of having those open and honest conversations with a knowledgeable lender. They can help you crunch the numbers, run different scenarios, and figure out which path aligns best with your priorities and your financial, comfort zone.
Couldn't agree more. A good lender will be your guide, your advocate, and your world of mortgages.
Absolutely. Okay, last question before we wrap things up. We've talked a lot about finding the right lender, but what about sticking with your current lender, the one you got your original VA loan with? Is that a good strategy, or should you always shop around?
Loyalty is admirable, but when it comes to refinancing, it's always wise to explore all your options.
So even if you had a great experience with your original lender, you're saying it's still worth seeing what else is out there.
Think of it this way. Refinancing is essentially shopping for a new loan, even if you're staying in the same house. And just like you wouldn't buy the first car you see without comparing prices and features, you shouldn't settle for the first refinance offer without doing your due diligence.
It's like comparing prices at the grocery store. Even if you love your usual spot, you might be surprised at the deals you can find elsewhere.
Exactly. Different lenders have different rates, fees, and underwriting guidelines. It's entirely possible that another lender might offer you a better deal, even if your current lender has served you well in the past.
So it never hurts to look, right? Knowledge is power.
Precisely. Gather quotes from multiple lenders, compare apples to apples, and then make a truly informed decision.
Well said. And speaking of information, for our listeners who are ready to dive deeper into the world of IRRLs, this fantastic article we've been discussing comes from National VA Loans.
They're a fantastic resource. You can reach them at 855-956-4040 or explore their website at nationalapplynow.com.
Perfect. We'll make sure to include that information in our show notes as well. And remember, knowledge is power, especially when it comes to navigating the world of finances. Don't be afraid to ask questions, shop around for the best rates and terms, and advocate for what's best for you.
Well said. Understanding your options is the first step to making smart financial decisions.
Absolutely. And there you have it, folks, your deep dive into the world of IRRLs. The ins, the outs, the what-ifs, and the how-tos. Until next time, happy refinancing.